Welcome back to the channel. My name is Brad, and today we are going to go through what is in my portfolio for March and what might be coming into my portfolio in the near future. So if that is what you're looking for, stick around. So this month has been a crazy month. Markets up, markets down. And I sold my IVV and QQQM. I still hold my Berkshire Hathaway. That is on my growth side of the fence. Yes, growth side. I sold this based the 200 SMA. Yes, the 200 SMA. How does that look like on a chart? If I look at a chart, you can see that SPY was going down and the bottom line is the 200 SMA. For those that don't know, 200 SMA is pretty much the equivalent of the 10-month. You're supposed to wait until it closes. I knew it was not going to get above the 200-day before it would close. So I went ahead and sold it that morning. That is what I did. Now, if the price gets above that 200 SMA, I will get back into something. As of right now, I am holding off on disclosing what I will be getting back into. Maybe a little SCHD or something like that, a little more secure with some dividends. Maybe I buy some Coca-Cola, but I don't want my growth side to be exposed to the total market because I am in retirement. Yes, retirement. I am not trying to grow this into a multi-million-dollar fortune. I've already kind of done that. That is why I am so focused on this segment of keeping that capital from going away. I need that capital just in case something goes awry with my income side. That's why I'm a little sensitive of big market drops, and I just want to protect that capital. I did get to enjoy a whole 30%, almost 33% growth in that capital since 2023. So that is that side of the fence. And we're going to talk about sequence of returns. So if you look at sequence returns, if you have a bad start and the market goes down quickly in the beginning, you can see that you don't have a whole lot of money in 10 years. If you have a good start, then you have plenty of money. And I'm taking 8%. This is really the important thing. I'm taking 8%. You can see the amount of years that it is good versus bad. So if it's a bad year, and bad years happen often, you can see how that affects your overall income. And just getting to the end part, you can see that we have a percentage of years of being bad is significant. So is this a good year or a bad year? I don't know. Nobody knows. But I am not going to risk my capital because I'm in retirement. And that is the importance of this. Sequence of return risk is important. Keeping that in mind, I'm not selling shares for my income. I am collecting the premiums and reinvesting the rest. On the growth side, I do the opposite. I let it grow. I don't have to sell it. But when I see a big market turn and it's going up and down, you just don't know. So you need to protect your capital. And that gets us to today's sponsor, Aura. Aura is a way to protect yourself from identity theft and online theft. What you don't want is to have your big bundle of money now get attacked for somebody to try to steal it, or do identity theft and open up a credit card in your name. Now, personally, we had that happen to us as a family. My wife had identity theft and somebody opened up a credit card in her name. And let me tell you, it's a hassle, a real hassle. It is a whole lot easier. You can freeze your credit right on the app, which is point one. It also takes you to the other two agencies where you can freeze your credit for free. And that's all in one spot, so you don't have to go back and forth. When my wife tries to go to unfreeze her credit, it is a good 2-hour task to get it done. Here, it's all in one spot. It also helps you with identity theft insurance, credit monitoring. Monitoring your credit after you had identity theft is kind of like installing a security system after somebody already broke into your house. You might want to think about that beforehand. It also has a VPN and online privacy. That is also pretty important. Antivirus comes along with it, as well as a password manager. And I use a password manager because I'm getting older. Can't remember all those passwords. Spam call protection. How many spam calls do you get in a day? Here, you can have spam protection. So that is why I have started using Aura for the last month. So if you're interested, link is down below for a 14-day free trial so you can test it out. It is something that I'm personally using just because I don't need identity theft and all the hassle that comes along with identity theft. So please go ahead and try it out for 14 days for free. Link down below. So enjoy. In my investing, I use 5 pillars. I use covered calls, business development companies, preferred stocks, alternative assets, Bitcoin, REITs, bonds, and I also use collateralized loan obligations. One of the key factors of what I do is I look at how far the market can drop before I hit my 8%. So a 24% payer has to drop 66.7%. That's why I choose to have some funds that are really high and some funds that are really low. Because if the market drops, I can still collect my 8% over time. And that's what's important to me as an income investor. Might not be important to you. Maybe you want some more growth. And we'll talk about that because I added a couple funds for a little more growth. And that can also happen with business development companies. Some grow a little bit more than others. So it's important for you to recognize the difference between the two. I still hold my SPY-I, my QQQI, my IWMI, my SPY-T, GIAX, FEPI, AIPI, of course my favorite on 0DTEs is T-SPY, and I also have a very small holding in GPTY. So I added a little GPIX and GPIQ, and I built that over time. And the reason I added these is they do better in capital growth. A little bit better capital growth than the others. So it's a mixture of both. So when you look at it, I have a little bit of growth. I have some funds that are high payers. So I'm mixing and matching, and that is for me. What you do is up to you. I'm just showing the example of what I'm doing. Now, on my business development companies, I have PBDC and BIZD. I've had these for a long time and they did very well for me. There is a link to an article down below about their expense ratios because that is the number one question I always get about these two funds is their expense ratios. And it has to do with business development companies and how they have to report the expenses of operations. It has nothing to do about management fees. It has to do about how the expenses has to get reported. But in the future, I'm looking to expand my business development companies. And the reason I'm doing this is I have a decent size in those two funds. And what I want to do is slowly build out over time some other funds like ARCC, TRIN, BXSL, FSK, Maine, and OBDC. And if you look at this, Maine definitely has more growth than the others, but it pays less. So combining these all together, I'm looking for a little growth, keeping my percentage up, but I'm just diversifying a little bit more, and these will be built out slowly over time. I'm not going to go sell anything to build these out, but I'm not going to reinvest in the others. Now for preferred stocks. And I'm going to call preferred stocks also baby bonds because I'm looking at some baby bonds also. So I added EIIA and I always had PFFA. And I did this strategically. One thing I don't want to do is get PFFA too large. I want to slowly take away a little bit of PFFA, but I also want that same percentage in bonds or preferred stocks. And I'm strategically picking these. I picked up EIIA below par. So at par, it pays 8.125. I picked it up below par, and that is important. So that's what I'm looking for. So I've identified some others that I'm looking at the right price. I strongly feel that I should be able to add OXLCI, ECCD, ECCF, SPMA, and TRINL at the right price. And I'm looking to get slightly above 8% and have it bought below par. So when they call it away from me, they have to pay me my $25. And that's what I'm looking for. So buy it at $20 and get my 8%. And when they decide, hey, we're going to call these back, we're going to give you $25. That's what I'm looking for. Or you buy it at maybe $24.75. So you made 25 cents per share when they called away from you, but you made your 8%. And that's what I'm looking for. Good 8% payer that when they called away from me, and that'll be just fine because they're going to call it away from me at a higher price than what I paid for it. That's what I'm looking for. That's how I'm going to play it. But you can do what you want to do, or you can just buy a fund that does it for you. The trouble of it is, for me, it's getting a little too large. So I'm looking to expand out, maybe 100 shares here, 100 shares there over the future. Not a whole lot, just expanding it to companies that I understand how they work, and I'm not afraid of them going out of business. They are triple B rated. That's something that we considered. They're also BB rated. So I'm trying to keep it a little bit higher in the ratings for credit. For my alternatives, I have BTCI. Now BTCI can drop all the way down to $35,000 for Bitcoin for me to still get my 8%. It does well. LFGY, I have a few shares there, and I take every week their income and I invest it in something else. I bought IYRI, and it's paying me that 11 to 12% on REITs. REITs might go up, REITs might go down, but hey, I'm still collecting my 11% on REITs. I also own HYBI at 9%. This has done well. During the crash, it really didn't go down. And that is something to be said. So I didn't have all my capital in equities. I also had some bonds. Now, in the future, what does this look like? I'm also looking at NEOS and their gold fund that they're going to be coming out. Waiting for that to come out. I think it's going to be interesting. It should be paying that something 9% or above, and it's based on gold. And I like that. It's a good hedge. I'm also looking at BNDI. I haven't made my mind up on that one yet. I might skip that one, but I'm definitely going to be looking at short-term treasuries. CSHI and FIAX for treasuries. Maybe a couple percentage in treasuries, getting that 5 to 8%. Yes, it's not my normal 8% high payers, but during a downturn, having treasuries and something secure helps you out and lets you sleep good at night. That gets me to my CLO collection. Yes, it is a collection. I have EIC, FSCO, OXLC, JBBB, SPMC, CLOZ, CLOZ, and JAAA. Now, all these percentages were from Seeking Alpha, and I got those numbers this week. Here is my whole thing with CLOs. I want to continue to raise myself up in the tranches. I love the BBs and the triple Bs. I can do a little less with single Bs and Cs, but EIC does a really good job of managing that. OXLC has that equity tranche. That's my riskier player in this group. And as you go up the tranches to JAAA, well, triple A's are higher rated than the US government at AA+. So that should tell you something about triple A's compared to the US government at AA+ in their credit ratings. So that is this month's what's in my portfolio. I collect my premiums, I reinvest the rest, and one thing I should state, my income is pretty much 2 times what I actually need to live on. I take the other percentage and always reinvest. I reinvest for a couple reasons. One, I want a pay raise every year, and I take 8% on cost. So as you get closer to retirement, keep that in mind. You at least need 130%. I have 200%, but I also have my growth side. And growth is growth, and income is income. Keeping them separate and not mixed. At least that's how I do it. And you can do it the way that you want to do it. Hopefully this gives you what's in my wallet and how I'm handling retirement. And you can get there too. So until next time, God bless.